ExxonMobil employees, and welcome. Thank you so much for watching. My name is Sam, and I will be your moderator throughout this presentation. In just a minute, we're going to be joined by Tyson Mavar, one of our senior financial advisors, and Tyson is going to be covering all of the key factors you should be thinking about when considering to take either the ExxonMobil pension as a lump sum option or as an annuity option. There are many factors that go into that decision, and Tyson will cover all of those with you. Before Tyson comes on, I'd like to just very quickly remind you, we are not affiliated nor endorsed whatsoever by ExxonMobil. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along. Throughout the presentation, I will be entering some links into the chat. Please feel free to click on those. They're going to guide you to several different resources we have available for you, including the complimentary cash flow analysis that Tyson will go more in depth about. And after the presentation has ended, you will be redirected to our homepage where you can book an appointment with Tyson or one of his colleagues if you wish and take advantage of several other of those resources that I just mentioned to you. And I think that's it. Oh, after the presentation has ended, I will come back on with Tyson very quickly to ask him some of the questions that we've been getting recently from ExxonMobil employees. So I invite you to stick around if you're interested in listening for those. If you have any of your own questions, feel free to ask away. It's completely anonymous, and we will do our best to address them either live, or I will make sure someone reaches you through phone or email after the presentation has ended. And without further ado, let's get into the content with Tyson Mavar.
Thanks, Sam.
Hey.
Good afternoon, folks. Thanks for attending our webinar series today. My name is Tyson Mavar, one of the ExxonMobil specialists here at the Retirement Group. Today's webinar series, we're going to be covering some of what I think to be the most relevant information related to the ExxonMobil benefits, and it has to do with the pension plan, different pension options, reasons people take one versus another, the interest rates that affect the lump sum at ExxonMobil, and just some stories that success stories that we've been able to enjoy with our clients who have taken a variety of different options, because it's not a one-size-fits-all decision. There's so many variables that go into what's going to be the best option for you and your family. And you never know for sure, right? Because we don't know how well the markets are going to do during your retirement. We don't know how long you're going to live. We try to do the best we can to make an educated guess at which option is going to provide the most total money to you and your family during your lifetime after you leave the company. So let's get right into it. So while the lump sum has been the most popular option, at least in my experience, for employees for the close to 14 years I've been working with the Retirement Group and working with ExxonMobil clients and prospective clients, it's not the only option. And there's been a variety of people that we've actually recommended take the annuity for one of a variety of different reasons. But there's actually multiple different annuity options, as it turns out. And as of, I think it was 2015, the company started allowing employees to do a hybrid option where you can take some of your pension as a lump sum and some of your pension as an annuity, 75%, 50%, or 25%. And this allows you probably more confusion because there's even more ways to take your pension now. But this is why we strongly encourage people to spend a lot of time evaluating these different options, the merits of all the options, running cash flow projections, talking with an advisor that has gone through this process with people in your same shoes, people that have retired from ExxonMobil, ideally, so that by the time you're putting your pension option down on your paperwork, you've felt like you've done all the due diligence that was needed to make such a big decision, and you don't end up having regrets in your retirement. So other than the lump sum, we have the single life annuity. That's the highest payout option as far as the annuities go, but it's for one life only. We have a joint survivor option, which is good for 2 lifetimes, but you're paying for that benefit because the life expectancy of 2 people, of course, is longer than that of 1 person. And although not listed on here, there's also a period certain option, which is just like the single life annuity, but there's an additional death benefit associated with it if you pass away in a certain period of time, 10, 15, or 20 years, which you get to choose. Although the longer that period certain you choose, the lower the annuity payout will be during your lifetime. And it just pays a death benefit to somebody of your choosing, assuming you pass away earlier than your life expectancy would suggest in retirement. So let's go into how these different options works. Single life annuity, more common for single individuals, but we've even recommended this option to some of our married individuals. I have one of my clients who his spouse had cancer 15 years before he retired. They thought they had all the cancer, but something in their mind told them that maybe it could come back, or there could be a reason to believe that his spouse might not live to a full life expectancy. His original intuition said to still take the joint survivor option anyway, just in case his spouse outlived him. He wanted to make sure that she was covered. But in going through some exercises, found out through a strategy known as Pension Max that he could use the extra money offered in the single life annuity to purchase a life insurance policy for his spouse. And he ended up doing this. And it actually was through the group life insurance plan offered through ExxonMobil to retirees, in addition to the basic life insurance that's offered for 5 years. You can pay a little bit extra to get an additional amount of life insurance. He did that. Well, unfortunately for him, the cancer came back for his wife. And within 3 years of his retirement, she had passed away. And as sad as this was for him and for me also, what he was able to do as a result of strategizing on his pension options was just to cancel the life insurance policy, and as a result have a higher payout for the rest of his life because he chose that single life annuity. So this is one example in many where understanding all of the circumstances in your life can help you to make better decisions that will ultimately get you more money out of your pension throughout your lifetime. So again, the highest payout option, reasons we see people taking this, might be because of a long life expectancy. Maybe you're very healthy and people live a long time in your family. Low risk tolerance. If you're somebody that just cannot stand volatility on your investments, granted, you're probably going to get a lower average rate of return on your investments as a result of having a lower allocation to stocks, for example. But the annuity could be a better option for you, given that it's going to be guaranteed, at least by the full faith and credit of ExxonMobil, that you will get a paycheck for the rest of your life. So those are two reasons I see people taking the annuity. But still, even in this higher interest rate environment and interest rates increasing in the last couple of years, we still see a lot of people taking the lump sum for a number of different reasons that we'll get into in a moment. Joint and survivor annuity options. There's a variety of different options within the joint annuity option, which will allow you to really tailor the amount of income that you receive as the ExxonMobil retiree, as well as what your spouse, or maybe not even your spouse, could be a non-spouse beneficiary, could be a partner, could be a child, could be a friend, it could be anybody with a life expectancy. So any living, breathing human can be chosen through this option. But the younger your joint annuitant, in other words, the longer their life expectancy, the lower the payout is going to be for both you and them, because the longer the joint life expectancy is going to be, depending on the ages. And now your outside assets and other circumstances are going to go into this decision as well. For example, if you're somebody whose spouse did not work or just does not have a pension, you might be inclined to take a higher payout, the joint 100% annuity, for example, which means a higher payout for your joint annuitant, but a lower payout for you, the retiree. However, if your spouse did have a pension, but maybe it was smaller than yours, so you wanted to ensure that there was some additional income, assuming that you predeceased them or they outlived you, then you might reduce it to, let's say, for instance, the 50% joint and survivor, which means there is a cut in total income to the household at your death, but it's not a complete removal of that income coming from the ExxonMobil pension plan. So again, working with an advisor that understands these options we found is very helpful. Running a cash flow analysis well ahead of your retirement, ideally, and updating that analysis regularly, at least annually, we recommend as we approach your retirement date, not only because, especially with interest rate changes, that could incentivize you to change your mind on taking the lump sum or not taking the lump sum, but changing circumstances could also change which annuity option you pick. And we find this to be really helpful to plug into a cash flow analysis and update that regularly based on changing circumstances. So the lump sum, what I would say is still, even in this higher interest rate environment that we're in, the most common option we see people take. Now, my data set could be biased given that people that are attracted to a lump sum more often work with a financial advisor versus somebody that took the annuity and had less decisions to make on how to invest that money at retirement. But it's still very popular. I would say a little bit less popular now that interest rates have gone up. But the flip side of that is that fixed income and safer investments in a retirement portfolio are now paying more, which now makes having access to your money more attractive, even if it's a lower amount as a result of how they calculate the lump sum at ExxonMobil. But what it is the actuarial equivalent of a lifetime stream of annuity payments. So there's two factors that play into how they calculate this lump sum. And they're just going to do a formula on, first of all, how to calculate the single life annuity, which is based on your years of service with the company, the final average pay, which is the average or the highest three of your last 10 years of service. And then they also have the Social Security offset function of the formula that affects both the lump sum and the annuity. Side note on that, it's sometimes the case where ExxonMobil will miscalculate your Social Security benefit and as a result are not giving you as much money as you are entitled to on either the lump sum or the annuity. And we can help you to prove to them if they did that wrong when we're going through your cash flow analysis. And we've actually seen a client get more than $30,000 extra money from their lump sum as a result of submitting their Social Security statement and proving that the company had incorrect data on this. But when they're calculating this lump sum, they're going to not only use those aspects of the formula that were just mentioned, but they're also going to use your life expectancy and current interest rates. The interest rates they use are a function of whether or not you are grandfathered. They'll use treasury interest rates if you're grandfathered, and they'll use corporate bond interest rates if you're not grandfathered. XTO employees by default receive these corporate bond interest rates or the higher interest rates, which produce lower lump sums, unfortunately. And they're also going to use your life expectancy, which means if you had a coworker that had all of the same statistics as you, same final average pay, same years of service, same Social Security projected benefit, but your ages were different. Let's say you were 56 and there's also age penalties that we have to keep in mind. But let's say you were 60 years old and they were 62 years old. All else equal, you would get a bigger lump sum than them because their life expectancy is shorter than yours. Now, if you were not yet age 60, there's going to be some age penalties. And those age penalties are 5% per year for every year under age 60. You not only retire, but you actually take your pension. You could retire at 55 and wait to take your pension and age out of those penalties. But we're seeing less and less people do that now that many money market interest rates and CD rates are higher than 5%. So you can earn more than the company is penalizing you in a safe environment now. So that's not much of an opportunity to leave the pension in there as it was 2 years ago when money market rates were 1%, for example. And maybe even better interest rates if you're willing to invest that money in less safe asset classes like corporate bonds, stocks, for example. Now, there could be still an incentive to wait to take your pension. And the biggest reason people are doing that today is because interest rates are going down into the next quarter. We're actually going to go into the interest rates in just a moment here. But because of the look back period, we can predict where interest rates are going and whether or not it's going to be more favorable for you to commence your benefit this quarter or next quarter. And this may actually govern your retirement date. If we find out that interest rates are going up and as a result, your lump sum's going down, if you were close to retirement anyway, you may actually get more money from the company by retiring earlier. Wouldn't that be nice? And that's been the case many times, especially in these last few years as we've seen rates climb, where we've been able to help our clients get an extra $50,000 to $100,000 in some cases on their pension, which means basically they were retiring earlier, which means they were working less and getting more money out of their plan. So this is something we pay a lot of attention to. We encourage you to pay a lot of attention to. And as we get especially close to our retirement date, something that we want to really hone in on the timing of our retirement as well as the timing of our commencement date. Keep in mind also, if you are over 65, which is the normal retirement date for ExxonMobil, it's possible you will not be able to defer the election of your pension. In many cases, they will give you up to a year to defer your lump sum election, which could benefit you if interest rates are falling in that case. If interest rates are rising, you'd probably want to take that lump sum as soon as possible and also get it invested as soon as possible. But keep that in mind, that age 65 normal retirement date doesn't mean you have to retire at 65. It just means there's a little bit different rules on how you can take your pension and when you can take your pension after you leave the company past age 65. Now, we hear from a lot of clients that it seems counterintuitive that when interest rates go up, my lump sum is going down. Think of this as a present value calculation, like if you're going to apply for a mortgage. Let's say you have a certain amount of fixed budget that you can afford to put toward a mortgage payment. And let's say that number is $1,950 per month. Go to a lender and they are telling you, well, wouldn't that be nice? These are old interest rates we're using. 4% is what they'll give you on a 30-year fixed, probably closer to 7% if you did that today. Well, let's say it was 4%. The bank says we'll lend you $408,500 to go toward your home. Let's say you go back a month later and interest rates have fallen to 3%. You still have the same monthly allowance or budget for a mortgage. Well, the bank is actually going to lend you more money. That money, that loan that they're offering has increased to $462,500. So falling interest rates have increased the lump sum that the bank is going to lend you. Same mechanics on the pension plan. When interest rates go up, the company assumes you'll be able to earn more interest on your lump sum, so they don't have to pay you as much money to make you indifferent between taking the lump sum and the annuity, given that you live toward the normal life expectancy that they're using for this present value calculation. So the look back period we talk about and focus on a lot because this is what gives us our crystal ball in figuring out whether your lump sum is going up or down. If you are grandfathered, which means the company is not only using 30-year treasury interest rates, which are lower rates and produce a higher lump sum, so this is a good thing if you're grandfathered. Something else that's different about that is that the company is going to use interest rates from 2 quarters prior to the quarter you commence your benefit. So here we are in the second quarter 2024. If you not only retire but take your pension, commence your benefit this quarter, the company is going to be using the lump sum interest rates from quarter 4 of 2023. This is different for non-grandfathered employees. Not only do they not use treasury interest rates, they use 3 corporate bond interest rates, which are higher and produce lower lump sums, unfortunately. The look back period is also different. They're going to use the 4th and 5th month prior to the quarter that you commence your benefit. So again, if I'm retiring this quarter, first of all, if I wanted to retire here in June, I would have had to have already retired by May 31st to commence my pension in June 1st, because only the 1st of the month is available commencement date for a non-grandfathered employee. So if I am retiring in June, I would get pushed out to July, and that might mean a change in my lump sum payout. Not only that, but they're going to, instead of using the entire 4th quarter data for interest rates, they're only going to use November and December, which is the 4th and 5th month prior to the beginning of the 2nd quarter. So all of this is very relevant in picking a retirement date as well as picking a commencement date, and it could mean tens of thousands of dollars more or less in your lump sum based on making good decisions on the timing on these things. So pay a lot of attention to this, especially as you get close to your retirement date. I'm going to zoom into our table here. We have the March and February data available now, which means we know what the 3rd quarter 2024, that we call them the blended rates. These are the average of these 2 months. And these are going to be what the company uses to calculate your lump sum. Now you'll notice that in this 3rd row of this table, we did the math to average these out, but we also compare that to previous quarters. The most important rows here are comparing quarter 3 to quarter 2, because if we know quarter 3 is going down, which we can see all 3 of these interest rates are lower, we can predict that lump sums are going to be higher in quarter 3 compared to quarter 2. Now, that doesn't mean you necessarily have to change your retirement date. You could have already retired and just wait to take your pension until July 1st, August 1st, or September 1st, all of which fall in the 3rd quarter and would, at least in this case, give you a higher lump sum. Or if you're somebody that wasn't necessarily ready to retire just yet, maybe there were some milestones you were working toward, or maybe you just wanted to earn a few extra paychecks. Now you're not forced to retire this quarter and commence your benefit this quarter, because not only is your pension not going down, it's actually going up on the lump sum. So we update these quarterly. We encourage people to keep up to speed on these things. Attending our webinars is one way. Just meeting with us, whether or not you're a client yet, schedule a quick phone call. We're happy to fill you in on what's happening to the rates at the time that you're talking to us, and we want to know a little bit more about your plans and your time frame and so forth, because there are a lot of other factors, not just the interest rates, but they're a pretty big one if you're somebody who's considering even taking a small portion of your pension as a lump sum, and certainly if you're taking the entire pension as a lump sum. Keep up to speed on what's happening with these. What we found, unfortunately, though, is that 74% of Americans over the age of 50 don't even have a written plan for their retirement. This is unconscionable as far as we're concerned as retirement advisors, especially given that there's a number of firms out there, including ours, that will run a cash flow analysis for you for free, completely complimentary, because we know that going through these exercises, you're going to find value in this. And we believe it's going to be a very good investment of your time. And that's good for two reasons. One is because we think that you're probably going to consider doing some business with us. And that's how we've grown our business the last over 30 years that we've been working with people from ExxonMobil. In addition to that, even if you don't do business with us, and certainly if you do business with us, we are confident you are going to help us grow our business after you spend some time with us by referring some of your coworkers to us. And that is one of the best ways that we've grown our business over the last 30 plus years, is by people like you, whether or not you become a client, telling people about us. And we want to spend as much time as possible with as many people at ExxonMobil as possible, not just to grow our business, because that's not all we're in it for. We're in it to improve our brand and our reputation in the long run as well. So let us know, not only if we have not done this for you, but if it's been over a year since we've done this, let's update your cash flow analysis, because a lot has changed, not just with the benefits, but also with tax laws that affect retirement accounts. Those seem to change almost every year. We want to make sure your plan is consistent with those, or being cognizant of the things that have changed as far as retirement tax law code goes. Now, we do have a little bit of time for questions, Sam. If any came up, it's either today or throughout this week. We'll open it up for a few minutes of questions if we have any.
Thank you, Tyson. Yes, I know we're kind of running over our time limit here, so let's try to keep it short. This first one. Is the annuity taxed differently if I have a $2 million lump sum of lump sum in their lump sum?
No, no, as long as we're assuming that your income was unchanged. For example, both of those are considered ordinary income. Mm-hmm. Same tax brackets as earned income, but different from a couple perspectives, because ordinary income doesn't count against your ability to collect Social Security early, for example. If you were somebody who took the lump sum, rolled it over to an IRA, and withdrew on a gross basis the exact amount that the annuity was going to pay you on a gross basis per month, the taxes would be exactly the same. I hear far too often people thinking that when they take the lump sum, they're going to be taxed on it as income the year that they do that. That's not the case, as long as you roll it over correctly to a qualified retirement plan like an IRA or 401k or one of the various plans that allow you to continue deferring taxes on that. If, on the other hand, you took the lump sum but decided to pay off your house that you owed $400,000 on, and you withdrew the money from the IRA, something we might not recommend. We might recommend structuring that differently to pay less taxes. That person might be in a 35% tax bracket, for example, compared to the person that took the annuity and didn't have $400,000 of extra taxable income that year. So very important on some of these decisions on how to pay off debt. But as far as taxes go, this is probably the best way we can help you increase your net worth without actually increasing your risk, just by paying less in taxes. And in some cases, the lump sum might actually allow you to be more tax efficient than the annuity in a variety of different circumstances.
Thanks, Tyson. Okay, we're going to answer one more. This is a pretty popular one. We'll try to keep the answer short here. I'm 65 and have a Social Security offset in my Exxon pension formula, which makes my Social Security appear low. Does this have an impact on my pension?
Okay, if I understand it correctly, the company for this individual is underestimating their Social Security benefit,
Hmm.
which means they're underestimating their offset and overestimating their pension. If that was in fact the case, we would not recommend telling ExxonMobil about it because they will fix it and it won't benefit you to do that. If, on the other hand, they were overestimating your Social Security benefit and as a result underestimating your both lump sum and annuity payouts, then we'd want to tell them about it because it can increase your both your annuities and your lump sum. And we are very familiar with running this assessment. We would just need your pension projection, which you can run on the Alight website now that they changed earlier this year. And we would need your statement on your Social Security so that we could verify the two. And it's important also to know that they use the age 62 projected Social Security benefit. Unless you're already past age 62, they're going to use your current age projected Social Security benefit. Another reason that the older you get, the less lump sum the company is giving you in some cases, not just because of life expectancy, but because your Social Security offset starts getting bigger once you go past age 62 and are still working at the company. Great question. I'm glad we could talk a little bit more about that issue with the ExxonMobil pension.
It's a great reason to book an appointment with you, Tyson, and get those specific little details figured out with you. Alrighty, Tyson, thank you so much for all of the information today. Thank you, everybody, for joining us. We hope you got something out of it, and we hope to see you again very soon on another webinar. Thanks,
Thank you,
everyone.
Sam.
Thanks.
Thank you, folks. We'll see you soon.